Welcome to another educational video from GinFi.com. Today, we'll explore recent market dynamics, focusing on the implications of concentration within major indexes and what it means for investors. Recent market conditions may have perhaps been a turning point in the aftermath of the recent better-than-expected report on inflation and the cementing, at least for now, of an expectation of easier Federal Reserve policy to come. Let's start with the massive weight now accounted for by the largest 10 stocks within the S&P 500. As you can see, they recently hit 38% of the index, which is well above anything seen in at least the past 50 years. The relative outperformance of the largest 10 stocks has obviously flattered capitalization-weighted indexes like the S&P 500 and the Nasdaq. However, the fuller story is being told under the surface of these cap-weighted indexes. This table covers three major indexes: the S&P 500, the Nasdaq, and the Russell 2000 index, which comprises small-cap stocks. To start, you can see that both the S&P 500 and Nasdaq have strong year-to-date returns, with a lesser return for the Russell 2000. From the lows of the pullback this spring, both the S&P 500 and Nasdaq are up more than 20%. At the index level, maximum drawdowns year-to-date have been limited to single digits, even for the beleaguered small caps, with the Russell 2000 drawdown not reaching even correction-level territory of 10%. But those maximum drawdowns are at the index level. At the average member level, the story is much different. In the case of the S&P 500, the average member maximum drawdown is 16%, which is classified as a significant correction. In the case of the Russell 2000 and Nasdaq, the average member maximum drawdowns are 30% and a whopping 40%, respectively. I'm regularly peppered with questions about how the market can be so resilient with myriad macro uncertainties, including inflation, Fed policy, geopolitics, and of course, the US elections. The answer, as you can see, is that resilience has been limited to the indexes, and that's courtesy of the outperformance of a small handful of mega-cap stocks. Reality, though, is much more nuanced and found under the surface of the cap-weighted indexes. Now let's stay with the S&P 500 for a moment. This table looks at the percentage of stocks within that index that have outperformed the index itself over multiple time periods. The first table is as of July 5th of this year, when the majority of these readings were at cycle lows. As you can see, a very low share of stocks were outperforming the index overall, regardless of the time period. This is where concentration risk becomes more acute. When a small handful of mega-cap stocks drive performance higher, but a shrinking share of the rest of the index is outperforming, it brings up the battlefront analogy, often used to describe breadth divergences. When it's only the generals, even if they are of the four-star variety at the front line, yet the soldiers have fallen behind, that's not a strong front. We may have hit an inflection point in this data, courtesy of the recent release of a much better than expected CPI report on inflation that was released on July 10th. As you can see, there has been an improvement in the share of stocks outperforming the overall S&P 500, especially over the past month. Now, although we don't expect this to persist consistently, we do expect to see more frequent bouts of improved performance away from the mega-cap stocks that have been the market's darlings since the 2022 bear market ended in October of that year. Now we can take a longer-term look at index constituents' relative performance. Shown here is the share of the S&P 500 having outperformed the index itself over the prior 2 months. It hit a recent low of only 14%, which was even more extreme than what occurred back in the bubble years of the late 1990s into the peak in early 2000. But you can also see this has begun to turn higher. Let's dive a little deeper with this analysis and see how this concentration issue has impacted the relationship between the cap-weighted and equal-weighted S&P 500 indexes on a year-to-date basis. As you can see, the cap-weighted S&P 500 has outperformed the equal-weighted S&P 500 by more than 11 percentage points. This widening spread between cap and equal-weighted performance is largely courtesy, of course, of the outperformance of the so-called Magnificent Seven group of stocks. As a reminder, Those 7 stocks are the 7 largest: Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, and Tesla, in that order, in terms of market cap. It's been our perspective this year, including having opined on it in our June mid-year outlook, that correcting some of this concentration excess could come via convergence with bouts of profit-taking in the mega-cap stocks, coupled with better performance under the surface and down the capitalization spectrum. Some of that convergence may have begun with its sustainability and greater focus now that the second quarter earnings season has begun. To sum things up, whether using the largest 10 stocks or a subset of that, the Magnificent Seven, it's clear that concentration hit historic extremes this year. The dramatic outperformance up the cap spectrum has flattered the performance of these cap-weighted indexes. But under the surface, there has been significant churn, rotations, and even turmoil to some degree. In other words, it's been a tale of two markets this year, but it's also been a market that has bred opportunities away from the mega-cap stocks. Whether you're looking at a small-cap index like the Russell 2000 or the equal-weighted version of the S&P 500, there has been notably stronger performance in the aftermath of that better inflation data. All else equal, the possibility of easier monetary policy has accrued to the benefit of stocks away from the mega-cap leaders. But let me conclude with this recommendation. We continue to think that there are opportunities within the so-called rest of the market, including smaller cap stocks. However, smaller cap stocks should not be viewed monolithically. They're not created equal. So for the stock pickers out there, we recommend staying up in quality, screening for stocks that have strong balance sheets, positive profitability trends, high interest coverage, and healthy cash flows. That's it for this video. Thanks for watching. Sign up at GinFi.com for more insights and personalized advice.